Experience in investing is really useful. You get to see business cycles, you get to meet lots of management, you get to see different business models, you get to see how emotions can take over. But I personally find that there is a downside as you become more experienced, and many of you have probably felt it too, because the more you see things, the more skeptical you become. And you become skeptical in investing because you see presentations and PowerPoints of company strategies that make so much sense. The Excel spreadsheet looks so amazing, and then it doesn't work. You see companies who fail to find funding when they say they have it. Management teams who say it's going well when it's not. And it's hard not to become skeptical. And so we're always fighting skepticism. Now, being skeptical will save you a lot of money, but too much skepticism is going to see you missing opportunities. And so one stock I want to talk about today is a stock I and the team were very skeptical about, but we changed our mind, and I'll talk about that one. What I'll also do is, I'm very energised at the moment. I'm not tired. I'm energised because we're just out of reporting season. We met with over 120 companies, and there's a couple of key takeaways I wanted to share with you from reporting season. And then finally, a non-conventional brand stock. You might be a bit sceptical about that, but we'll see how we go on that one. The ideas you're going to hear today, the stocks you're going to hear about, are really, a representation of what we do at Firetrail and in the Australian High Conviction Fund. It's a fund that's been running since October 2005, so almost a 20-year track record of delivering for clients. And really the hallmark of the strategy is concentrated value and growth. So out of reporting season, one common remark I heard and felt was that it felt like share prices were moving a lot more around results. And if it felt that way to you, it's because statistically they were. So what you can see here is standard deviation of stocks around their reporting date. And you can see February 25, it was the most volatile reporting season since 2010. What that specifically means is a 9% standard deviation, or close to 10%, means that 2/3 of stocks move plus or minus 10%, and the other third move greater than 10%. And that's the most we've seen in 15 years. Why is that happening? In my opinion, it's because we're seeing more short-term participants in the market who are trading on a much shorter time frame. And many of those participants are pricing information more aggressively. So I'm not going to say more efficiently, but definitely more aggressively, because we know there's rules of thumb like there's never just one downgrade. Downgrades come in threes. So if you see one downgrade, the market will now start pricing in three straight away. It's getting very, very aggressive out there when it comes to information. What are the implications for you as investors, for us as fund managers? The first one is there is more opportunity for active management. Deviations from fair value create opportunities to make money. The second one, though, is you've got to be prepared for stocks you like to deviate further from fair value. Because as they get more volatile and price bad news, which may be temporary, these stocks are going to get very cheap at times, and you've got to be patient. So with volatility comes opportunity. The second one that we heard, and this was a real theme across many different companies, was that the energy transition is slowing. I don't know if it's because Trump was elected, and I'm not going to make any judgments or make any political statements, but this reporting season, I heard from a lot of companies change their tune from 18 months ago around how they see the energy transition going. And the key theme is that it's going slower. So a couple of examples or choice quotes that I've pulled out here. The first one is the chart on the left. This is car sales data, so they don't really have a dog in the fight. They don't care as long as cars are being sold, EVs, ICE vehicles, combustion engine vehicles. But what you've seen is intention to purchase EVs has declined to the lowest level in 4 years. That's despite massive stimulus. EVs are around 7% of new car sales, but you can see there's declines there. Origin, 18 months ago, when we were meeting with them, they said, we don't know how the energy transition is going to work out. We could meet some of the targets, or there could be a lot of challenges. Now what they're saying is we're seeing it being disorderly. What does that mean? Well, it means what they see is more renewables going into the grid, which is variable in nature. A good solar farm will run 40% of the time. A good solar farm will be 20%, and a good wind farm will be 40%. That's sort of world class. Batteries that are going in, that's typically the solution. Grid scale batteries run for 4 hours. So if the wind stops for a bit, you can turn the battery on. But if we have a shady period for days and weeks, we're going to need more gas. And gas power stations are not being built into the grid. Origin sees it more disorderly. BP, major oil and gas company, this is just from a week ago. This was their transcript. Our optimism for a fast transition was misplaced and we went too far too fast. So they were aiming to lower their fossil fuel production. They're now looking to increase it. There's a few others there. The last one, Macquarie Group, formally withdrawing from the Net Zero Banking Alliance. This is a major step. Like you think about Macquarie's positioning, the investment in the Green Bank, this is a major step back from Macquarie, and it can be all put under, in my opinion, the energy transition is slowing. Now I wanted to change tune a little bit and talk about this stock that I was very sceptical about. It's a stock called Block. Hyperion were talking about it. I'll give you a quick overview of what they do. Block has two divisions. It's US listed. It's now listed in Australia after they made a takeover for Afterpay, which was very poorly timed and they massively overpaid for it. But that was close to 5 years ago now. But they've got these two divisions. So the first one is Square, and you can see that little symbol. What do we call it? Logo. It's when you tap. That's what they do. They've got 4 million SME customers, and the SME customers pay them 1% of whatever goes through the till. And you can see on the chart on the left, that purple line has been growing. It's been growing at around about a 15 to 20% CAGR over the last 5 years. So it really is a growth business. The green one is actually bigger. It's called Cash App. Cash App is a mini bank. So it started out as peer-to-peer, so where I could transfer money to you very easily. It's been very hard in the US to do that kind of thing. You can do it based on a mobile phone number or a cash tag, which is like an Instagram handle. It makes it really easy to transfer money. But then they've loaded in a lot of functionality. So they've loaded in stock trading. You can do Bitcoin. You can get loans. So it's turning into a mini bank with 57 million customers. But it's fair to say this gross profit, so there's cost below this, but gross profit has been growing 30% per annum across those two businesses for the past 5 years. So it's been a very fast grower. The reason the Firetrail team were sceptical was because the costs were out of control. This was classic tech hubris coming out of COVID. We're going to grow forever. Have a look at these costs. Up and up and up. It was absolutely out of control. Headcount in Block grew 46% in 2022. So what happened was Jack Dorsey came back and inserted himself in October 2023. And he came in and he said, you know what? We're not letting costs grow anymore. They had 13,000 people at the time. He said, we're going to take it down to 12,000 and we're going to have that headcount cap across the business. Now that's where we were sceptical, but one of our analysts, we always get them if they're passionate to go and do as much work as they can and try and convince us. And he had to convince us not once, not twice, 3 times. But Jack Dorsey did come back. And if you look at what happened to costs since then, costs have been held flat. So it's been quite amazing, and we were super sceptical, but it's happened. And the result was that cash earnings exploded. So they lost $145 million in 2022. Then they made $340 the next year. Then last year, just finished the year, $1.6 billion. This year, they're guiding to more than $2.1 billion. So Block isn't some hope trade, high-tech, loss-making company anymore. This is a company that's actually growing its earnings. This cost control has really led to strong profitability. Now, if you look at what happened to Block's earnings, and you saw Charles's chart before on Aristocrat, Block's earnings have been stronger. It's gone from $1 of earnings per share to $4 and probably going higher. And so, obviously the share price is okay. So this is the opportunity. The share price has gone nowhere despite all this happening. And so you can ask yourself lots of questions. Why is it? Is it the balance sheet? Well, no, they've got net cash of $2.3 billion. Is it way overvalued? Well, no, it's 20 times PE at the start of the week, and now it's on 18 times PE. It's got great valuation, and the earnings are actually likely to inflect very positively as well as they launch Afterpay on Cash App. It's been 5 years in the making. We're very positive about that, and also some Square product improvement. So it's fair to say Block ticks a lot of blockses. Yes. So at least I didn't have to say it was a joke. Not that funny. The second stock I wanted to talk about, this is the biggest position. We made it the biggest position in the high conviction fund through reporting season. We thought IAG had a really good result. The stock fell 15%. We bought as much as we almost could. and it's rallied about 10% since then, which has been really good. But IAG is a leading insurer in Australia, and it's got some of the best consumer insurance brands in the world. Now, the CEO said that. How do I feel about that? I wrote it down to make it interesting for you. But if you look at the brands they do have, they are very strong. They've got RACQ now, they've got NRMA, and they've got RACV. That gives them about a 30% market share on the East Coast in insurance, consumer insurance, which is home and motor. In New Zealand, they've got the two brands there with 50% market share of New Zealand. So these are very strong brands, and that gives them a really good competitive advantage, because if you have a strong brand in insurance, people will pay more for that, because they'll trust you that when something bad happens, they will send someone to your house. I'm with NRMA, and I recently had an issue in my house. A fence fell down, and they sent someone out the same day. And now I've told you, so hopefully you go and sign up with NRMA as well. And brand does matter, and people will pay a price for that. With scale as well, you get lower costs. So the big picture is IAG is a market leader in consumer insurance. Now, IAG is in the insurance game, and inflation and natural perils, which you can see here, fires, storms and floods, are something they need to price. And IAG has systematically underestimated the cost of natural perils in their business. If you want to know what the weather is going to be, do not ask IAG. Here's how they've performed on their track record of the weather losses they thought would happen for the year and what actually happened. And so the red is bad. That means they've gone over, the worst year they were over by about $400 million. The cat budget this year, to put it in perspective, is about $1.2 billion. So it's been bad more than it's been good. 19 years they've missed, 14 years they've gone way unders, and then they've had 5 better years. However, you've all been receiving your insurance premiums, no doubt, over the past couple of years. Maybe you write some risk as well, insurance business, and you've been seeing 20, 30, 40% increases in premiums. IAG has repaired any issues from inflation, but they're very worried about being regulated by the government, and having seen what's gone on with the supermarkets, I think that's a fair position. What IAG has done, instead of taking all those excess profits and put it into earnings per share, they've gone out and done major reinsurance deals. What that means is the quality of IAG's earnings has improved markedly. We'd make a bet, and I guess we're putting the money where our mouth is, that IAG are very, very, very unlikely to exceed their cat budget. Alfred just came in. You saw what's happened there. They've probably got about $30 million of losses on that. They've done some amazing deals on reinsurance. The key point is the quality of the earnings has improved a lot, and that's going to mean this is a real go-to defensive in our book, as those earnings are less volatile going ahead. So let me put it all together for you. We've just come out of reporting season. What we saw was volatility rising, and we've seen this slower energy transition as well. Block, very sceptical about it, but it looks incredibly undervalued. It's growing very fast, and it's likely to beat expectations in our opinion. And then finally, IAG, they've got the weather wrong for about 15 years. This cycle has meant that we believe now they're in a period of beating expectations. Thank you for those of you who invest with us in the High Conviction Fund. If some of those ideas I shared today sound like you, or you are interested, we do invite you to invest alongside us in the Firetrail Australian High Conviction Fund. Thanks for your time.